Diversification is something you always hear about. But what does it mean? The idea is pretty simple. It means choosing a bunch of different investments with unique characteristics to help reduce your risk. There are many different types of investment risks, but market risk is what we'll focus on in this video. Market risk is the possibility that the entire stock market falls, and diversification is a way to help reduce the potential impact of that on your portfolio. Here's how you can think about it. If you cluster all your investments in one area, like going all in on one industry, you might be setting yourself up for a harder hit. But if you spread out your investments and some event strikes the market, your portfolio potentially can take the hit a little better. The primary way you go about diversifying your money is choosing the main parts of your portfolio, like how much you're investing in stocks, bonds, and cash. But it also applies to picking which stocks to buy or looking for other investments entirely outside the stock market. Basically, instead of going all in on only one or two types of investments, your money goes in a bunch of different places. This helps protect your portfolio from market volatility, which is just a fancy way of saying the ups and downs of the market. Imagine you have this portfolio. With only 3 slices, it's not looking very diversified. Then, volatility shows up. Let's say it's a dip in the market and impacts one of your asset types. Volatility really has an impact on this portfolio. Look at all that red. Now, imagine you have a more diversified portfolio. When volatility shows up and we color in the same asset, you can see it doesn't take up nearly as much of the pie compared to the undiversified one. Keep in mind that diversification does not mean you're guaranteed to profit or that you're protected against loss. What it does mean is that you can reduce the risk in your portfolio while maintaining the potential for higher returns than if you hadn't diversified. Okay, so that's diversification. Now, how do you harness its power for yourself? Thanks to the professionals at Fidelity Investments, here are 3 steps I've learned you can take to get started in diversifying your portfolio. First, you gotta have a game plan. Think about why you started investing in the first place, your goals, time horizon, and how comfortable you are with risk. Second, choosing your strategy for diversification. There's no one-size-fits-all here. It really depends on your plan. If you ask 100 people how they diversify, you'd probably get 100 different answers. But let's talk basics. There are 4 primary parts that can help create a diversified portfolio: domestic stocks, bonds, short-term investments, think money market accounts and CDs, and foreign stocks. You're probably wondering, how much money should I invest in each one? That's a great question to ask yourself because it's the most important factor in determining the long-term risk and return of your portfolio. This idea is called your asset allocation. How much you allocate goes back to your risk level, time horizon, and goals. Stocks historically have had a higher potential for growth, but more volatility. Meanwhile, bonds have historically been less volatile. The same goes for short-term investments. If you have a long time before you need the money, like you're saving for retirement and are not planning to retire anytime soon, you may have more time to recover from market volatility. Nobody can predict the market, but we can look at past data to see how different allocations handle the same volatility. Here are 2 hypothetical portfolios. One is more conservative, the other focused on growth. Both have a mix of domestic stocks, bonds, short-term investments, and foreign stocks. But half of the conservative portfolio is in bonds, while nearly half of the growth portfolio is in US stocks. Let's look at the worst and best returns in any 12-month period for each portfolio. For the conservative portfolio, the worst return was almost negative 18%, and its best return was 31%. For the growth portfolio, its worst return was negative 53%, but its best was almost 110%. As you can see, the conservative portfolio was able to take hits better, but didn't reach as high returns compared to the growth portfolio. After you've established your portfolio's allocation of domestic stocks, foreign stocks, short-term investments, bonds, and any other assets, you may want to consider also diversifying within each one. Let's take a closer look at domestic stocks. Imagine you notice you're only investing in one type of stock in your portfolio, tech. You could diversify more by investing in other types of stocks like healthcare or blue chip. The same goes for the other parts of your portfolio. If you're trying to diversify, don't go all in on a single style of investment. Okay, so you've established a diversification strategy. Now, there's one more step. Consider checking on your portfolio from time to time to see if your strategy still lines up with your goals. What might have fit your goals for diversification a year ago might not fit them today. Remember that example of the conservative and growth portfolio? As you get closer to retirement and using your savings, you'd have less time to recover from a down market. So you might consider rebalancing your allocation to be less risky so that you experience less volatility. Market fluctuations are a normal part of investing. The most important thing is having an investment plan that helps you stay focused on your goals and look beyond short-term market events. One thing you should keep an eye on is how your allocation changes over time. If one area of your portfolio is doing awesome, then it'll make up a larger allocation. When this happens, consider adjusting your allocations again so it fits with your diversification plan. Okay. That's just a small slice of the diversification pie, but this should give you a good idea about why it's such an important concept for investing. Have a question? Drop it below in the comments or check out Fidelity on social, where they discuss all sorts of topics like this and more. That's it for now. Till next time, investors.